In this video, we're going to look at Secure Energy Services, and this is a Canadian oil and gas equipment and service company. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock, and then look at the financial ratios of that company and compare them to its competitors. And I do this with you throughout the entire video, so it's like we're doing it together. So let's get started with the model. This company has a market cap of $272.5 million, and everything's in Canadian dollars. They're currently trading at $1.71 a share, $1.71. And let's get the free cash flows for the company. Free cash flow is the cash that's remaining after operating a business minus capital expenditures. And the way you value a company or an asset is you estimate the future free cash flows and then you discount that number back to today's value. And that's exactly what we're doing in the video here. I'm pulling now the net income, which is the profit and loss on the income statement. And I'm going to put 4 years of that into the model. And then the revenue, which are the sales for each year. And you can see the sales have gone up a lot. They went from 1.4 billion to 3 billion. So that's a pretty nice increase. And it looks like their free cash flow was negative 1 year, but positive 3 years. And they had negative net income 2 years. So it looks like they're still growing and investing in their business. So let's get the capital structure of the company so we can figure out the discount rate to apply to the future cash flows. They pay $25 million of interest on their debt. Let's go to the balance sheet to see how much debt they have. We'll go to the liabilities section. And long-term debt of $453 million. That's debt due after 12 months. They pay 5.5% interest on their debt. Interest payments are tax deductible, so let's get their effective tax rate. Let's use a 2018 number. Their income before tax was $36 million, and their income tax was $16 million. That implies an effective tax rate of 45%. So the cost of debt is 3%. Let's get the cost of equity. We need the beta. That's how volatile the stock is relative to the entire market. And they have a beta of 2.78. So that's a really high beta. That's a really volatile stock. So the stock moves nearly 3 times the market. Let's go back to the balance sheet and get their current assets. We need this number for when we look at the current ratio later. And current assets are $314 million. We also need the current liabilities for the current ratio. And current liabilities is how much money the company owes within the next 12 months. That's $210 million. And equity is the value of the company according to the balance sheet. That's $780 million. And EBIT, earnings before interest and taxes. On the income statement, they call that operating income. That's $24 million. So let's look at a capital structure. The cost of debt is 3%, and the weight of debt is 37%. The cost of equity is 24%, and the weight of equity is 63%. So their weighted average cost of capital is 16%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all future cash flows after year 4. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $345 million. We divide that by 159 million shares, and we get an intrinsic stock price of $2.16. It's trading at $1.71, so it's trading at a 21% discount. So it's a buy according to the model. Let's see what Simply Wall Street. They're a little higher. They're at $240. So they're also saying the stock is undervalued. Let's see where it's been trading the past few years. So it looks like it was trading about $12 a few years back, and then it's been dropping ever since. So investors aren't willing to pay as much for this company anymore. They may see the value dropping over time. Let's look at the financial ratios of the company to get more information. They have a terrible PE ratio of 170. That's price of stock, which is 171, over earnings per share, which is 1 cent. And to get earnings per share, it's net income over shares outstanding. So they're not bringing in much income, so that's why their PE ratio is so poor. They have a really good price to sales ratio though. That's price of stock 171 over sales per share. So sales per share is revenue over shares outstanding. So they are generating lots of revenue relative to their stock price. They're just not converting that revenue to profit. Really good price to book of 0.3. That's price of stock $1.71 over book value per share $4.89. And to get book value per share, it's equity, which is assets minus liabilities on the balance sheet. Equity is $780 million over shares outstanding $159 million, $4.89. So book value per share implies that if the company went bankrupt today, liquidated all its assets, paid off all its liabilities, each shareholder would receive $4.89. That's in theory, of course. Current ratio 1.5, so that's good. They can cover their current liabilities. Current assets are 314, current liabilities are 210. 0% ROE because they're not bringing in much net income. Only $2 million net income over $780 million of equity. But this may be a long-term play, and possibly in the future they'll start bringing in more net income. They could cover their interest payment just once. Interest coverage ratio is EBIT over interest expense. So they can't even cover it once. They're a little under 1. It rounds to 1. They're at 0.97. So that's not a good sign. So I imagine with the low oil prices, this company is struggling to pay off its interest payments. There's an article in Motley Fool dated July 5th of this year, and it talks about Secure Energy Services cut its dividend from 27 cents to 3 cents. So obviously this is a company in an industry that's really struggling with the low oil prices. This stock could go either way. If this company could get through the pandemic unscathed, it could end up coming back up to $5, $10 a share. On the other side of the coin, it might end up filing bankruptcy if it can't get through these times. The best way to look at financial ratios is to compare them to similar companies. I did a video on Halliburton, which is the same industry as Secure Energy. And Halliburton doesn't have good ratios either. It has negative ROE and negative PE because, as you probably guessed it, it has negative net income. Halliburton's ratios don't look that great, but it's a massive company, $11 billion market cap, compared to a tiny 273 million Canadian dollars for Secured Energy. So a company like Halliburton can handle a difficult time like coronavirus and has the capital to get through it. So let's see what happens with this company. It could be a good long-term play. It's a bit risky, but let me know what you think of the video. Thanks for watching.